Hello traders, Gary Wagner here. It is currently 12:01 in Honolulu, 6:01 in New York on Friday. Happy Aloha Friday, as we say on the islands. It is the 14th day of October, 2022, and this is the Daily Report for Gold and Silver, our weekend review. Traders, yesterday's CPI report showing that core inflation has actually risen was a game changer. Yields gained tremendous value with the 10-year note breaching 4%, currently at 4.010. The 30-year bond is actually inverted to that, yielding 3.978%. Incredible. We had dollar strength that followed that, of course. The dollar up 0.84% at 113.195. And to the precious metals, it absolutely had a tremendous and detrimental effect on gold, taking gold down by $26.80 or 1.6%, with the December contract currently $1,650.20, and silver losing almost 4%, 3.8% to be exact. And after factoring in today's decline of almost 72 cents, is currently at $18.20 per ounce, basis the most active December contract. To say that yesterday's CPI report was a game changer would be an absolute understatement. The big news was not that the CPI actually went down from 8.3 to 8.1%. It is that the core CPI actually rose from 6.3% in August to 6.6% in September. That's a game changer because it's going to force the hand of the Federal Reserve to become even more aggressive. There's almost a 100% certainty that they'll raise rates by 75 basis points in November. I believe the actual number was 98.7% according to the FedWatch tool, and about a 70% probability that will be followed by another 75 basis point rate hike in December. If that happens, that means the Fed funds rate will effectively go to 4.5%. And in fact, many economists are calling for the Fed funds rate to be at least at 5%, even 6% by March of next year. That will have a profound impact across all of the asset classes. First, let's take a look at the dollar. The 10-year note actually rose above the 30-year bond today, yielding 4%. Higher yields absolutely move the dollar higher, and that has an inverse and negative effect on gold. So that's what I want to cover first. Right now, we have the dollar index at about 113. It's risen as high as 114 on a weekly chart. I'll show you why that's so important. Long-term studies suggest that we could see the dollar really grow from here in terms of value against the basket of currencies, because when we say a strong dollar, we certainly don't have a strong dollar. In fact, what cost us $100 last year now costs us about $108. So the word strong is misleading. I like to say if you're looking at a basket of rotten apples, the dollar is the least rotten of the bunch. But 121 seems to be a very logical number, only because that was the highs that we saw in 2000 and 2001. It also matches up with a 1.23% Fibonacci extension. It's a very, very long-term extension, but let's use a shorter chart for what I believe will be a more accurate reading of where the dollar could go. We are looking at a weekly dollar chart with a Fibonacci extension, and the reason I believe this will give us better results or forecasting ability is because it begins at 2018 before the pandemic. That is our first measurement up to when the dollar hit 103.67, which occurred at the beginning of 2020, and down to these lows of 89 that occurred right in 2021. So it's covering the period of the pandemic, recession, and recovery. From there, we saw the dollar move up immensely. And in fact, Right now, the highs match up almost exactly to a 1.618% Fibonacci extension at 11452, and that is obviously why we saw, at least on a short-term basis, this price point being a top. We've declined from there. However, this news, as I said, with the core CPI actually continuing to grow after 5 rate hikes, is a game changer, which means we have to look at a new level of numbers. The first thing I'm going to say is that a 2-time Fibonacci extension takes us to those highs of 2018, and that would be a logical point that I would look for a potential for the dollar to do. On next week, what I want to discuss is if the dollar goes to 120 to 125, which is what I am forecasting, what will that do to the price of gold? As far as gold goes, initially, a higher dollar is absolutely going to pressure gold lower, unquestionably. But there's a wild card to all of this, and that is, where will higher interest rates take the economy in terms of a recession, in terms of the global picture itself, and will there be a tipping point when market participants focus upon spiraling inflation that the Fed has not gotten under control, the central banks are still tackling. Remember, in the Eurozone, CPI is at 10%, and people focus to gold as a hard asset, regardless of what the dollar is doing. But before that happens, I think we could see in the short term, gold head lower. And as I said, we'll explore that next week. But with this solid break today, which broke through the 61.8% fib retracement, and this retracement begins in 2020 when gold was at 1,450, up to this year's record high of 2,078. This hard break right here at 1,690 is exceedingly important, because what that tells me is that our next real area of major support comes between 1,590 and 1,600, and that is based upon the 78% Fibonacci retracement. Again, there is no way to underestimate the importance of what happened this week, and that the Federal Reserve has been unable to lessen inflation after a series of dramatically strong rate hikes, and the fact that they're going to go to an extremely high Fed funds rate has ramifications that are beyond what people thought were possible even last week. This has been Gary Wagner wishing you, as always, good trading. We will talk to you on Monday for the next daily update and review. Bye-bye.